I'm a CPA with a graduate degree in taxation, and today we're doing a video on my blog on the best method for investing in U.S. real estate for the foreign investor. And got a lot of questions, a lot of comments. I've updated the blog a few times, but I wanted to go through and do this video, kind of read the blog and give some annotations, because a lot of the concepts we have in the United States or in business law are unique to the United States. I want to explore them with the viewer. If you have any questions, of course, the phone number is right here in my blog, which you can get by getting to my website or just doing a search term. And the phone number is 949-939-3414, and that's in California. A major concern to the foreign investors is the American death tax. The death tax rate is approximately 45%. The death tax applies to all U.S. assets if the worldwide value of the descendant's estate exceeds $60,000. So I want to just pause here. A lot of people think the U.S. property has to exceed the value of $60,000. But the way this law works is you take the $60,000 and you prorate it to the U.S. property. So if 10% of your total worldwide net worth was in the United States, the exclusion value is $6,000. So if you own a home that cost $1 million and that was 10% of your total worldwide net worth, you would pay death tax on $994,000. That was $1 million less $6,000. And you can always brainstorm this with me if you have any questions. Ownership by a trust is the only method to avoid death tax. Wealthy Americans have used trusts for estate planning. The trust must not be revocable or subject to amendments. Usually a person who transfers property to the trust may not be a beneficiary. However, there are exceptions. So when it's your home, we have a special type of trust, and we'll go into that more. It's not actually in this blog. It's a little bit technical, and it would take it make the blog too long for other people to enjoy. The exception for this is a discretionary trust, where there's no intention of monies being paid to the trust settlor, and this is what we work on. The IRS has a variety, or Congress has passed a variety of laws that allow a special type of trust. They're known as a qualified personal residence trust, and it allows you to live in the house and keep it outside your taxable estate. I really wrote this blog because, and this is the main reason, some people believe that if a foreign corporation owns the real estate, they avoid U.S. death tax. While shares of a foreign corporation are not a United States asset, this method does not avoid the death tax. The tax code has a special provision that defeats this planning. Now, for those who want to look it up, it's section 2036. And this provides that the shareholder owns the assets of the corporation. Now, this law only applies to death tax, so not an income tax law. And our tax code has different sections for income tax and death tax, and the two are not coordinated, or as they do not work in tandem or with each other. Section 2036 applies if you can enjoy the income or the property of the corporation. So if you're in the home, you're enjoying the property. Since you're the shareholder, you can enjoy the income because you could declare yourself a dividend. I have a link here, which I will go to, that really gets into this law more deeply and also talks about some other problems for the foreign corporation when it's dealing with a U.S. business. Corporate ownership of U.S. real estate has an income tax problem too. Corporate ownership subjects the income to a second tax. When a foreign corporation is the owner, the tax is known as the branch profit tax. When a U.S. corporation is the owner, the tax is known as the accumulated profit tax. Okay, the best method. The best method is to have a trust form a limited liability company in the state where the real estate is located. The LLC owns the real estate. Now, I have a diagram here, and we're going to go to a explanation of this. You'll see on the very top of this diagram, there is a box for the trust for the benefit of your family. And this is a trust. We usually do it in Nevada because they have the best trust laws. And then down below for this box, the trust is run or managed by a corporation that you own, and we call that the trustee. In this box down here, you'll see I have 3 limited liability companies. Let's see if I can plan that for you. And in my example, I have 1 limited liability company to own rental real estate. Now, an American limited liability company is similar to a corporation in that the debts of the company are not the responsibility of the owner. So when you're owning rental real estate, because of the risk of somebody getting hurt or other items, we have a lot of laws here about our environment. It's always good to own any real estate, either in a corporation or a limited liability company. The LLCs has become the most popular for a variety of reasons, and you can give me a call and run an expert of those. I have a second limited liability company to own the family home, so not the same one. Lastly, over here, just as an example, if you're investing in the stock market or you own shares of U.S. corporations, those assets are also subject to death taxes. So you should use the same trust structure to own these shares here. There's another advantage. As a domestic trust, the cost of IRS reporting is less. A trust tax return is about $1,000 per year, and any CPA can do a domestic trust tax return. You don't need an expert like myself. When you're doing a foreign corporate return, you need an international tax expert. We charge more per hour, and there aren't that many of us. The fee runs about $10,000 a year, but there's more. Only 1 in 10,000 domestic trusts are audited by the IRS, compared to 1 in 500 foreign corporations. So that is it. Of course, there's a little ad here for my book. But if you would like to learn more, give me a call or play around on my blog, and I thank you for watching this video.